Hello, everybody. Kirk Spano. It is Monday, January 13th. Retirement income options for margin of safety investing and fundamental trends rare members. Did a little bit of updating on the margin of safety website, and that'll all be coming over to fundamental trends too. I write it over here because it tickers when I need to have things tickered. I don't have to redo that somewhere else, so it just carries over. I redid the Mosey and facts just to bring it up to date. So go ahead and take a look at that. I would like you to pay attention to the fact that 2 weeks before the end of the year, I was trying to tell you that things were going to get choppy. So I have the quarterly outlook and game plan pinned to the top of the articles here. Teresa, back from vacation, doing Teresa stuff. That's awesome. Retirement income options trade updates from last week. Make sure you take a look. And even with volatility, the world does get better over time. So always keep that in the back of your head. I updated the resources section. So you have the facts and webinar information, which I updated both of those. And then these are the things that you're going to see every quarter or month or year. So the very short lists I have started to update. This is the 2024. However, I can open the 2025, which, as you can see, has a biotech very short list or watch list. And it's pretty long at this point, over 50 companies, probably going to add about 10 more. So it's going to be a pretty extensive watch list for biotech. If you noticed in the news, Eli Lilly and Johnson & Johnson both bought companies recently. I think that the consolidation in the biotechnology space is going to be pretty huge over the next 3-4 years as the FTC doesn't oppose too much. And I think that there are a lot of big pharma and big biotech companies that are going to be looking to acquire technology and talent and incorporating it with their own data sets and their AI systems. So I expect a lot of companies on this list to get acquired in the next 4 years or just do very well. Others will fall apart, but it's going to be our job to figure out which of these are going to beat the market. And you go to the end, you have Kirk's notes, which I will be adding some of these over time. I haven't done the potential upside and downside for these yet, but it's coming. I don't know that this is right. Yeah. This is from something else that used to be in there. I think Agilent was in this row before. There we go. All right. So Global Trends ETF. I've been updating that. You can see I have one closed-end fund that made the cut. Closed-end funds just really do suck. I know that people want to think that they're a good idea, but they're wrong. They're high expense, they're leveraged, they get crushed in corrections, and they trail the S&P 500 as a rule. So it's very, very rare that you find anything in the closed-end fund universe that will beat the S&P 500 total return over time. So why bother? I added the First Trust ARCA Biotechnology Index. Why? Because it's equal weight, it's focused, it only has about 30 holdings, and I think that it will probably continue to be a leader in that space. So while XLV has been the leader over the last 5 years, you can see that FBT, which is equal weighted across 30 stocks, has beaten the biggest biotech ETF, which is overweighted as a cap-weighted index to the very biggest companies. So I want some exposure to the smaller companies. I took a look at this one and XBI, and then there was a couple of others from Virtus and other companies. They weren't liquid enough. They didn't show a good functional track record over the last 3 and 5 years. Even over the last 1 year, I would have taken a hot fund if I thought it could hold up. So I'm taking a look at these 3 biotech funds. However, I think that we are very likely to need to be in a stock pickers market for biotech. I made a lot of money on Exact Sciences when I was buying it in the single digits. It went up to about 30. I sold a bunch of it, started buying it back at 20, at 12, and backed up the truck when it went back down to 5 and 6 from 30. So you can see how volatile these are. If I'm right, and this is a choppy year and almost everything gets beat up at some point, we should be able to buy a lot of these biotech stocks dirt cheap. So I'm looking to build a basket of at least 5, up to 10 or 12 of these names. All right, what can we talk about today? So there are a lot of options expiring on Friday. Somebody points that out in the chat. And basically all the covered calls are going to expire. So I am probably going to write a bunch more covered calls right away. So next week, I would expect to be writing covered calls on everything that expired, probably at the same strike prices, and then out into the second quarter. Now, I normally don't go out more than 2 or 3 months, but I think that the covered calls, you're going to want to collect as much premium as possible. So I can see going out to June on the covered calls. I think April will be pretty standard, but you might be able to do May or June if it makes some sense. I'll probably stagger mine through the second quarter just in case Uncle Jay Powell surprises us to the correct side of the equation. And the correct side of the equation is that the Federal Reserve should be lowering interest rates quickly. Everybody out there who's an inflationista, the people who've been mostly wrong for 40 years, keep talking about rates needing to go higher to fight inflation. And that's bullshit, as I have explained many, many times. So for every time you hear the drums of, oh, we got to raise interest rates because of inflation, think to yourself, how much inflation has there really been since the early 1980s? And the answer is not much. And how much has there been since the financial crisis? One little bout brought about by the fact that we had to shut down the economy, broke all the supply chains, which were already fractured from the first Trump administration, a manipulative OPEC that cut oil production, and a manipulative China when it comes to global trade. And I say manipulative China because they were winning. We manipulate too, we just fell behind. And now we're catching up. We were catching up under Trump. We were catching up under Biden. And I think we're going to finally catch up soon in the next 4 to 5 years. Of course, you know that at about 2030, I think there's probably a boomer retirement financial crisis that runs into a perfect storm with private credit, the end of a deregulatory period. I really think about 2030 is the year. I had talked about 2029. I think 2030 makes more sense. Why? Because Scott Bessent is going to write a lot of 5-year treasury notes. So rather than writing 2-year notes, 2-year bonds, the way that Janet Yellen had been the last couple of years, anticipating lower rates, I think Bessent is going to be smart enough to know that rates have to come down. However, I don't think they want to have to deal with this again in 2 or 3 years. I think they want to be done with refinancing the debt wall that is out there, which is due now and through the end of next year. I think they want it to be done. I think they're going to write a lot of 5-year treasuries instead of 2-year treasuries. And during that time period, we will get lower interest rates. Next year, with the new Fed chairman, presumably, I think we probably get quantitative easing, or at least quantitative tightening is over with if Jerome Powell doesn't end it first. The liquidity situation is getting tighter. Financial conditions have been getting tougher since interest rates started going down. Here's that chart. So when we started lowering interest rates, financial conditions got tougher. Not supposed to work that way, but people are people. Stupid is as stupid does. So what I think is going on here is we are going to let play out a mini crisis because none of the Trump reforms are going to be in force until next year. You're going to see a lot of deregulation. The banking system has already been getting their way with the Fed. The banking system is asking for lower reserves and more flexibility on a number of things, just like they did in the year 2000, right before Bill Clinton left office. And while I don't think it will be as egregious as the deregulatory period of the George W. Bush era, mainly because I don't think President Trump has the time, I do think that we are going to get over deregulation. Just like I talk about the two-party system probably being the right one, where we pass through equilibrium once in a while. I think we're going to go from over-regulated to under-regulated, and maybe for a hot minute we pass through just right. The porridge is just right. And maybe someday we get to just right, But the hyper reactive voting public, 60% of the people who don't understand much at all, which is unfortunate, used to be a lower number of people who didn't have a clue. But I think the number of people who don't have a clue on the economy has grown as we have watered down the educational system the last 40 years. But all we can really do as investors is do our best to understand what is understandable, to know what can be known, and to prepare ourselves for unknowns. And I don't just mean the known unknowns, right? Things where we say this could go this way or that way, but for the black swans, the things that are out there and we can't see just yet. And I'm pretty good at finding them. I think the private credit thing is going to be a big deal down the road as we deregulate. I think a lot of those firms that do subprime lending are going to get crushed to the point of bankruptcy. But I think it's out there about 4 or 5 years, maybe as soon as 3, but it is hard to nail the time frame here. In the shorter term, we know that financial conditions are getting tougher, and we know that the Fed is probably going to pause on lowering rates because there's enough narrative out there, enough noise about inflation that the Fed's going to say, fine, we wanted the stock market correction anyway, so we're not going to lower interest rates. If you think inflation is a big deal, I want you to understand why I would say that it's not. Deflation is the boogeyman. And if we fight inflation, especially if we fight it the wrong way with higher interest rates, we could get stagflation because we could simultaneously slow down the economy and cause more inflation. Well, how can that happen? Because the biggest component to inflation right now is housing prices, followed by insurance, followed by energy. And really all three of those things kind of play together. But if housing is a problem for inflation, what is the very simple Econ 101 equation that you all learned as freshmen in college or saw a video on, or maybe you were lucky and learned it in high school? What is the Econ 101 equation for lowering housing prices? What do you need more of? Somebody says an increase in houses. There you go, houses. You need more houses or multifamily. And I corrected somebody on the Seeking Alpha website today. They were talking about the 30-year mortgage, and I said that's not that big of a deal. It's an extra point or two. Who cares? What you want is for the price of the house to come down, not for the interest rate to come down on the mortgage. But you do want one interest rate to come down, and which one is it? It's the 5-year U.S. Treasury and shorter durations. Why? Because construction loans and the notes on multifamily buildings are how long? 1 or 2 years for construction and 5 years on a multifamily or a company that's building a subdivision. So it's the short end of the curve that impacts new housing starts. That's what we need to have enough of. If the construction industry slows down, which won't just be housing, it'll be everything, because really all construction is based on what I just said, right? Companies don't take 20 and 30-year loans. They take 1, 2, 5, and occasionally 10-year loans. Jerome Powell talked about how he was slowing down construction and housing. But he also knows, because he also talked about how housing is a big component of inflation. So here's the thing that the inflation hawks can't wrap their head around because their Austrian ideology, right? Austrian economists who've been captured politically and ideologically since almost day 2, they refuse to say out loud, even though they must know it, that if you lower interest rates at the short end, you stimulate construction, in particular for housing, and that brings the cost of housing down at the price level. And then it doesn't matter if the long end of the curve is a little bit higher because the national debt dictates it from the people who are lending to us. And you'll hear the phrase bond vigilantes. Yeah, not really. It's just that the people lending us the money are saying, look, dude, we don't want to give the United States money for 10 or 20 years unless we know that we're going to beat inflation. So you can't give us 2 or 3% on the long bond. You need to give us 4, 5, 6. And that's fine. It's what it's always been. That's normal. So think this through. If we build a lot more houses and the price of houses comes down because we're smart enough to only deport the criminal illegal immigrants, not the nice ones that just want to live here and work here, that don't break any other laws. Because if we do get rid of a bunch of them, pick your comedian of choice. Who's going to build all the stuff if we get rid of the immigrants? Mexicans in particular, right? It's a funny joke when you hear a comedian lay it out there, but it's a very serious reality. If we eject more than just the criminals, that's bad for the economy, bottom line. So we can grow the economy a couple of extra percent by lowering interest rates, stimulating construction, and then having the people here to do it so that labor costs don't skyrocket. Will rhetoric win, or will ideology win, or will economic common sense win? Well, we'll see. In the meantime, we know that we're not getting a reconciliation bill until probably May. Might be a little bit later, but May seems to be the target. And I'm hoping that they replace the EV tax credit, because they really want to, with a tax credit for home builders. For every new home built that's over 1,000 square feet, give the home builder, whether it's an individual or a company, $7,500 right off the top as a tax credit. Most of those companies are profitable, and anybody who build a house has income. So a $7,500 per unit income tax credit is pretty powerful. It's in line with what Kamala Harris was going to do. She was just going to hand out money. But because none of the people who build a house are broke, a tax credit for building new homes makes a lot of sense, since that'll lower the price at the lower end. Then the people who need starter homes will probably get better starter homes for cheaper, because everybody builds from the middle up, right? Nobody's really building a starter home, and we shouldn't. We should never build starter homes. We should always build middle class up to luxury. I'm looking at building a 3,500 square foot house, just me and Jolene. Why? Because I want to throw a party here and there and have the grandkids over. I want a library, and I want to study. I want a guest room, and I want a room for my mom and dad, but on the opposite side of the house. So, those are the sorts of things that should get built. If you got the money to build a $500,000 to $1 million house, here's $7,500 off your income taxes. Go build it. When I talk about things like that, I'm not just throwing shit on the wall. I've sent this to the people I know that can send it to places where people who make decisions will read it. And that's the way the system works. There's a lot of people who are connected to people who are connected to the people who are connected. Just start putting the ideas out there. Here's a paper on it. Here's an article. And that's why I think President Trump has the opportunity to do a lot of good things. Will he do them? I don't know. I like to play craps, and I think that this is about the same odds. I just don't know how I'm going to do that day. I'll have a good time. And back when I used to drink much, I would drink as fast as I could because the drinks were free. But, I hope I don't feel that way when they start kicking out the rules and writing the tax regulations, because I'll be able to read through it and I'll know what the impact is mostly going to be. And if they just lower taxes across the board, they're just going to create more debt. They're not going to solve anything. They have to go after housing, and they should go after the healthcare system. We'll see. We've been waiting a long time for these things to happen. We're 0 for the last 4 presidents, so we'll see, right? Yeah, 0 for the last 4. These problems have been around a long time. We'll see. We have not had a great president this century yet, in my opinion. And the reason I think Trump has some opportunities is because some of the ideas would get support from the left, and he's clearly in control of the right. I think he can get things over the finish line if he chooses to do it. Again, we'll see. So in a market where I think that the financial conditions are going to get tough for a while, and I've already been telling you to trim and write covered calls, I'm going to do something, and I already have the orders in, that I don't do very often. Can anybody guess what it is? What am I going to do with a put option? I'm going to buy puts right on the money. And here's what I'm looking at. I am looking at the March, because you really don't want to pay for a lot of time premium, $550 put on the S&P 500. I'm looking for a rally, a few days of rally, which usually happens going into options, to get a good price. So this option right now costs $7.22. I'm going to try to get it for 3 or 4. Might not get there. So we have to monitor this on a daily basis. What you really want to see is a big update in the stock market because of something that doesn't make any sense and really doesn't matter. You get lots of days like that. Oh, the market went up today because of this. The market went down today because of that. What is the best description of those narratives? 1 word, 2 syllables. Farmers say it. Bullshit. The narratives that you get over and over and over again are mostly bullshit. I'd say 80% bullshit. Falls into the Pareto principle. I've been going on Seeking Alpha articles, and I don't criticize the authors. I just write a paragraph which is not in tune with what they wrote. And here's what I can tell you. The number of people who argue with me is roughly the same as the people who like the comments. So that means that about half of the people out there have no business managing their own money. They ought to be indexing or hiring me. And that means for us, we have some opportunities. So if we can get into this put, right, just a blanket put, S&P is at about 580 right now. right? 580. What's the underlying? About 577. So we're not looking for a real big correction, right? 580 divided by about 30-point decrease. Whoops, stupid calculators. Do what I want, not what I say, right? About a 5% correction. Now, here's the thing. If the correction gets a little deeper, you start to make money. You start going up this slope. If suddenly we have a 10% correction, we get down to about 520. There you go. Suddenly, that's worth $22 plus whatever time value is left. That's a triple. What if we fall off a cliff and all of a sudden we're down here, 120 points into 580? 120 by 580, about a 20% correction. What if we really have a bear market and it's fast and steep? Now all of a sudden, we've got 10 bagger on this put. Now, here's the other thing to think about is the time value of the put will start to disappear quickly at the end of February after that option expiration. After the February option expiration, when you only have 4 weeks or so to go, you're going to start to see the time value wear off fast. So probably the week of options expiration in February, you're going to roll this out to April or May. And you have to accept, if you're going to make this trade, that you're probably going to roll it out unless you get lucky on the front end. That's how option buying works. If you're going to buy options, you're the speculator. You're trying to get the time frame just right. Usually you don't. You just have to make the trade 2 or 3 times once in a while, or 4 times, to get that big pop. If you can get the options cheap enough, it works. If you overpay for your options, don't bother. There's no point overpaying for an option if you're buying it, because you lose the benefit of time value. You lose the benefit of a price move. You've just overpaid for something. It's like going to the used car dealership and saying, oh, look, the new car is 50 grand and the 3-year-old that just came off of lease is 40 grand. Well, I'm saving $10,000. So I'm going to buy the $40,000 3-year-old car. As a guy who's had an auction license, I can tell you, you're a sucker. You should be paying between $20,000 and $30,000 for that 3-year-old car, depending on if it's a luxury make or not. After 3 years, you're supposed to pay between 40 and 60% of the original sticker. That's what you're supposed to pay. Those car dealers try to get you to pay 80, and then they crack you on the financing if you need financing. Don't get cracked on your option premium. If you can't make the numbers work, you can't turn it into a triple with about a 10% correction in the market, it's not worth doing, or in the stock. So this is the one I'm targeting. I'm going to try to get it for $3 or $4 in the next week, I think. I'm hoping for a couple of days of rally in the stock market, some hopium on the inauguration and on the options expiration on Friday. Maybe I'll get it, maybe I won't. But if I don't, I'm already holding cash. I've written some covered calls. And the covered calls that we have expiring on Friday, I'm going to be rewriting those on Monday, Tuesday, Wednesday, probably Monday. By the way, Wednesday and Thursday are usually the down days in the market. Monday, Tuesday, Friday are usually the up days. It's been holding that way for a very long time. And that's why you buy on Thursday afternoons and sell on Tuesday afternoons. Weird, right? Just the way it ebbs and flows. It's the tide. Somebody asked about Enovix. Nothing to talk about with Enovix. It's a great company. And as I've been going through the very short lists, I will tell you, I think the batteries are to play. I think Enovix is going to be one of the big winners. Why do I say that? Because the solar technology, the wind technology, and the geothermal, mainly the wind and solar, mainly the solar, is just changing so fast that it's hard to pick the winners in solar, especially on the technology side and the manufacturing side. I think the installation networks, where they can charge for services, do the best. This is consistent with various other industries where you have the same setup vertically. Who makes the most money, the manufacturer or the service provider? It's almost always the service provider. So we have the 2 TJ Rogers companies, Enovix and Complete Solar, that I've been buying. And if you wanted to sell a cash secured put because you already have a position on Enovix, depending on what your position is, I think I'd probably be writing the Aprils, which is a little longer than I normally want. Stock is 1086. I guess you could write the 10 for April, get a $1.48. That means that your net cost, if this is put to you, is about $8.50. That's the 52-week low, basically. So if I had room to sell, right? If I had a starter in Enovix or even a half position in Enovix, and I wanted to keep building that, I think I would sell the April $10 put, collect my $1.50. And if it gets put to me because there's volatility, great. If it doesn't, great. And if it doesn't, I'll just do it again, or I'll buy stock, right? One of the things that happens is Enovix might be under 10 for a lot of that time period, then go over 10 by the expiration. So you have to watch it, because maybe in February or March is the bottom, and you should try to buy a little bit then. And sometimes it'll still get put to you, and you're like, oh, I bought it because I didn't think it'd be down there. It was like 950, went to 1050. I bought it at 950. Well, then it got put to me at 10 because it was 999, right? Then you decide, is my position too big? If it is, then you can just write covered calls that say 11, probably make $1 against the shares that were assigned to you at 10. And all of a sudden, you probably have a 20% gain on your hands. Oh, the pain of the gain. This requires some management. And I know that some of you are new, some of you are not, most of you are not. But the idea of set it and forget it and don't pay attention cannot be your philosophy if you're managing your own money. I'm not saying day trade, I'm saying pay attention. At a minimum, you should be checking on your portfolio every weekend, and then probably Tuesday at a minimum. I don't think it hurts to look, 4 times a week though, on the weekend, and then Monday, Tuesday, Wednesday, maybe Thursday. But usually by Thursday, you're out of stuff if you want to be out. You just set your limit orders to buy again, half an hour a day. You're going to do it yourself. I think you can get by in about a half an hour a day, and really almost every day if you throw in your reading. Speaking of reading, I was very disappointed with a lot of you when I asked during the question and answer, how many books have you read? And half of you had read 2 or fewer books over the last year. For God's sake, you should be reading a minimum of a book a month. Well, but I listen. No. It is good for your brain to actually read. So read these books. These are the books I really like. I really like all the high school class books that I put out. I think that if you read these this year, your life would be better. And then next year, maybe you read the undergraduate investing books. Maybe the year after that, you get to the graduate level, right? Most important economics book ever written. Intermarket technical analysis. This is the 3rd level thinking, right? This is the 3-dimensional chess that I talk about. Options and futures. How machine learning is going to change everything. And it's going to change who we bet against and how we bet against them, and how we use them as our proxy for risk management. Somebody asks, would you sell puts on Rocket Labs or AST Space Mobile with the pullbacks today? I've written a bunch of covered calls on those, so not me. But if you don't have at least a half position in Rocket Lab or ASTS, yeah, sell some puts. They generally come with really big premiums. I think it's pretty easy to see that they'll both be S&P 500 components at some point. Rocket Lab is 24. So if you wrote a $24 cash secured put for April, you're gonna get $475. Your net price on Rocket Lab would be 20. That's pretty good. Now don't blow your wad in case it goes down to 15, and then you just buy it, or you write another cash secured put. I'm guessing EST Space Mobile is going to look about the same. Down to 20. So on April 1750, you get 239. That means your cost would be down around 15. And remember, if things get bad, don't blow your wad, just in case it goes to 12 or 15. You got to write another one. So go slow, go easy, understand your position sizing. Not a lot of stocks should be a full position. I think Rocket Lab and AST Space Mobile should be. And on the housing thing, I'm going to add a couple of builders to the very short list, actually to the punch cards list, to the punch card stocks, because I think that the only way under this administration that we get out of a recession, besides printing money, is building more houses. Trump is a real estate guy. That's what he understands. Biden was all about climate change. So if we get a pullback on these builders, and there's an ETF that we can do this with too, and I might just stick with the ETF because I think I'm just going to like the group. I do think that there's 2 builders ETFs. So ITB is one of the ones I'm going to be looking at. And this way I don't have to figure out which home builder, right? And I get Sherwin-Williams, and I get Home Depot. I think this is going to be the one. But look at the chart. It just does nothing but go up until there's a big correction. And I don't know that we're going to be able to get it way down here at 75. But that would be a gift. We can get this one in the 70s. Oh, That's a gift. My guess is we can get it in the 80s. This is where he's going to direct money. So I think that's it for today. I haven't eaten yet, and I'm getting hungry. Packers lost, so I guess I'll be working on Sundays again. Everybody, enjoy the playoffs. Enjoy the Super Bowl. I think we might do something fun for the Super Bowl. We might do something. Might do something. Oh, by the way, guess what? Guess who's going to be in Las Vegas for the money show? That's right, this guy. So if you happen to be in Las Vegas, let's see here. Live events, in-person conferences, money show Las Vegas. So if you happen to be in Las Vegas, February 17th to the 19th, I'm going to be there, and I might be a presenter. Just might. It's not cheap. It's like $200. So if you just want to hang out at a craps table, let me know. Maybe that'll be the promotion. Maybe the promotion for whoever picks the Super Bowl winner and loser and the score gets to play craps with me. How's that? I think that's a huge prize. All right, everybody, have a good day.